You mentioned Europe may be heading into a very long recession. What's your outlook for the U.S. effectively?
Okay, again, so it's that outlook. For those of you that are new, and Darius might do some doodling today, I'm gonna warn you. Once he starts doodling, I mean, one thing I promise, we won't get Brian McGough in here because he will not leave the doodling.
He will do Oh, man.
Okay, so what is that? 2 seconds, sine curve, okay, sine curve. Where is GDP? When it was down here, coming out of here, kind of 2011, accelerates. Acceleration, Q2 of 2015, plus 3%, okay? That was your cycle, the most recent edition of a U.S., what we call U.S. economic expansion, or got to, and this is year-over-year GDP. GDP peaks, rolls down, now we're at 1% year-over-year GDP, okay? So the question, and this is an ongoing question for Wall Street, where is your view of this, which would be classified as a recession? You'd have 2 quarters of sequential, that's how they define it. However they define it, they can define it. I don't particularly care. All I want to do is get these rates of change right. I've said this multiple times, but I'll say it again. Provided that you don't get a 0% GDP environment and that you stay somewhere around 1, but not greater than 2, and the Fed is like tricked into raising rates like they might at any given day because they're politicized, this is perfect. This is bad. If the Fed raises rates, we're going to go here faster. Simple?
Bingo. Yeah.
Our predictive tracking algorithm is currently running, correct me if I'm wrong, Darius, but let's put this up here. Q3, Q4, Q1. Then we'll put some little color in here. This is GDP now on a quarter over quarter, or a SAR. Darius can tell you what that means in a second. Well, what does SAR mean, Darius? Just so everybody knows.
Seasonally adjusted annualized return.
Yep. So if you don't know what that means, you probably shouldn't. But the reality is that that's the sequential look, which is the year over year, is what I'm showing you here. We're for Q3. We're at, actually did we update for the retail sales number last?
Yeah, it's 1.1 still.
For I think this was 1.7.
No, you mean the SAR. Sorry. Yes, 1.7 is the SAR.
Okay,
1.7.
1.1. See this? That's what they're. Okay. Now, Q4. This comes down to 0.8%. And Q1, oh no, sorry, this is 4. 0.4%.
Yep.
And then minus
0.8%.
0.8%. Ooh. We're dancing with the devil in the pale moonlight here, Federal Reserve. If you get this to be negative on the right deflator and you get back-to-back negatives, you're in a recession.
Yeah.
You could have been in a recession in the second quarter if the Fed didn't go dovish. That's the point. When the Fed goes dovish, you get a reflation of asset prices, a reflation of the ISM have bottom view, a reflation of anything that's PMI driven, sentiment driven, charts, but you didn't change the overall year-over-year reality of gravity. You've had head fakes, but if the Fed goes hawkish instead of dovish, the probability of this being worse than plus 0.4 and worse than negative 0.8 on a sequential basis goes up. Okay?
Indeed.
So that's the way that we think about it. We think about the probability. That's why we run a predictive tracking algorithm with 30 different back-tested data points every single month. So that's 90 data points. We're completely and utterly and ridiculously data dependent. Every single client that we have that's nailing it this year, either performance is up high single digit or something in the double digits, agrees with this 1,000%. The rate of change drives macro. So again, we've talked about this. I'm going to do this slowly and methodologically. Up 3%. We've talked about this. So if this is GDP in the U.S., this was the peak of the cycle. This is your life at the peak of the cycle. This was the second half of 2014, okay? Sorry, 2015. Damn it, I almost had it. I was on a roll there until I messed that up. Second half of 2015, 3%. GDP growth slows down to here. What's the number? Again, you could start an RIA on this or a hedge fund charge 2 and 25. So pay attention. Make sure you articulate this to people because this is like so basic a reality and it could have had you winning this year and I bet a lot of you are. GDP has slowed from 3% to 1%. This is called a cycle, okay? Central planners say that they're going to eliminate this picture. It never changes. Cycle peaks, cycle rolls over, you're here. There's this thing called the consumption cycle. And there's this other thing called the cyclicals. Now, let's do the cyclicals first. They peaked over here. Okay? So cyclicals peaked in the second half of 2014. They are at 1%. They're at negative, somewhere in here, tracking negative numbers, okay? That's the cyclical side of the economy. Industrials, again, cyclicals, energy companies. Ask an energy company how he's feeling versus how he was doing back here. There are a lot of guys that are actually dead. I mean, their companies have gone away. Lynn Energy trades at 0.05, 5 cents per share, okay? So a lot's happened in here. We know that. That's why everyone says, oh, but Keith, the slowdown from here to here is going to recover because this stuff's going to come back. And then I say, I empathize with you. But then there's this other thing called the consumer. So the consumer, the consumer is over here. You see that? You see that? The consumer. The cyclicals are called cyclicals because they cyclically peak first. This is called GDP, and then we have this thing called late cycle. So again, consumer peaks last year. You could have, what was the peak on consumer spending that we just had there? It was 4 to 5%, right? Depending on what quarter.
Yeah, I think it was 3.6 was the
Plus
peak.
Plus 3.6%. Let's call it, if you want to call it 4, you round up to 4. Now we've slowed, look at this. Oh, we've slowed here to like 2.7, are we at that?
Yep.
Okay, so this is the cyclicals, double dip recession. There's nothing that's bottom there. This is still coming down. This thing, which is 70% of this thing, has gone from here to here. And where does this go next? Where does that go next? It doesn't go up. This number is a 9-year high. Actually, right in here. They're comparing into here. We're comparing against, let's show that slide 24, Josephine. For PCE growth, we're talking about against 70% of US GDP. You can see we're comparing against, if you use a two-year comp basis, so that helps you smooth out the weather. You can go all the way over to the Q3 2016 two-year comparison of 3.2%. That's a 9-year high of a comp or a comparative base period. Okay? So in other words, back to this, Josephine. For 9 years, you went from here to here and hung out in here, now you're rolling off that. And that's your comparison. 9 years. So you tell me, and I am happy, and I will happily debate anybody on Wall Street on this. Anyone. You know, I'm not all that, but they aren't either. I think they've proven that adequately. Just for those of you that are new, and again, I always like to thank all of our new subscribers because we have, God willing, we keep growing like we are, and I know that there are a lot of people that need to. I think it's good to repeat, whether I'm coaching my 9-year-old hockey team or the analysts here internally, I think it's good to repeat. I mean, when we go to church, we do repeat the same words. At the end of the day, if you don't go to church, then that's fine too. I'm just telling you how I think about it. So repeating the process is really important because it helps. It really helps fortify your understanding of why you're doing what you're doing and why you're paying us. So again, from a trade, so we have 3 durations. We have trades, we have trends, and we have tails. These are 3 different durations, okay? 3 weeks or less, 3 months or more, 3 years or less. The big calls are obviously right in here, between 3 months and 3 years. But if you're asking about the trade on the S&P 500, that line was 2171. We've talked about when that broke, you saw me go net short in real-time alerts. You saw me shorting things, and not shorting SPYs because I'm not a monkey. I got better shorts than the SPY. We have 30 at least high quality, super hugely high quality short ideas that our team puts together. We have 40 analysts, so that isn't even 1 per analyst. So again, I go with the short ideas that we have. But again, if you're just trading SPYs, I give you the roadmap, I give you the levels. You're a big boy and you're a big girl. You can do that on your own. So 2141 is the trend. What happens when something breaks both its trade and trend line? All the guys who are hanging out in the moving monkey land of the 50-day, freak, okay? Why do you think I built the model this way? I love front-running the emotion of the crowd. There are a lot of people who use 50, 200-day moving monkeys. Don't be them. Front-run them, capitalize on them. They are emotional. They react after the fact. So again, use the trade and trend lines between, again, we're 3 weeks or less and the three months or more durations as a good leading indicator of how you can position. And again, when you position more convincingly, and you'll see me do that, when a market goes bearish trade and trend, I'll get much more negative. But if it just breaks its trade, I'll be plenty negative. I certainly won't be long that market. And that's the point, even if I like it. So EWM, which we just got asked on, Malaysia, broke its trade line 2 weeks ago. Why would I buy it? I mean, it's now under attack. I mean, why would I buy something that's under attack that has plenty of reason and plenty of beta, by the way, to go down while I'm writing to in every product that we have that low beta is what I want to be long. Malaysia might be a fantastic place to visit and a nice place to rent in EWM terms, but I'm certainly not married to the damn thing. It's got a lot of beta, and I want to be low beta. I want liquidity. I want bonds. I want gold. We've been very, very clear on all this. So again, once you understand the process, you can start to understand why I'm so convicted in putting those pieces together. I spent a lot of time screwing up. I can guarantee you that you have not screwed up publicly as much as I have. It's probably impossible. I've hit all 3 networks and left all 3. I'm here every day. I put every single trade that I thought of since 2008 in real-time alerts, which is thousands of signals. Nobody, there's not even anyone who's probably in the area code of having their mistakes as well publicized as I have. So I am forced to learn faster. Imagine that. And I have learned faster, and I've hired people that are much smarter than me help me understand where I could fail next, so then we eliminate the possibility of those failures. So again, putting it all together is why we sound the way that we do. I know the conviction scares people sometimes, but I'm confident because I should be. I'm confident in what we built, and I think that you should use it to your advantage.